Welcome back to the channel, everyone. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeezes, using a very specific example that recently popped up on our screen. We're going to dissect Smart Logistics Global Limited, ticker SLGB, and explore why it's grabbing attention. But first, a critical heads up. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about SLGB. Smart Logistics Global Limited operates in the industrial sector, specifically within integrated freight and logistics. This is a company providing business-to-business contract logistics solutions in China. They handle industrial raw materials, line haul, and only transportation services, along with value-added offerings like truck parking, freight storage, and truck examination. With a market cap of just $35.03 million, it's firmly in small-cap territory. Looking at recent price action for SLGB, it's been a bit of a roller coaster. Today alone, it's up plus 4.67%, and over the last 5 days, SLGB has surged an impressive plus 42.99%. However, if we zoom out to the last 30 days, it's actually down minus 1.75%. Volume-wise, today we saw 694,554 shares trade hands, which is significantly lower than its 30-day average volume of 7,376,695 shares, putting its relative volume at a mere 0.1x average. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB, and why should it be on your radar? When a short seller wants to bet against a stock, they first have to borrow shares from a broker. They then sell those borrowed shares, hoping to buy them back later at a lower price, return them to the lender, and pocket the difference. The borrowing shares isn't free. Brokers charge a fee, known as the cost to borrow. This fee is typically expressed as an annualized percentage. Show graphic, CTB formula/explanation. When this fee gets extremely high, it's a clear signal of intense demand to short the stock, or a severely limited supply of shares available to lend out. Imagine paying over 100% just to hold a position for a year. There's a massive overhead that puts immense pressure on short sellers if the stock doesn't drop quickly. Why this stock is hard to borrow right now. Now let's bring it back to SLGB. This is where it gets really interesting. Our hard-to-borrow screener flagged Smart Logistics Global Limited because its cost-to-borrow fee is an astonishing 10.09% annualized. Yes, you heard that right, over 1,000% per year. This is an incredibly high fee, indicating extreme scarcity or very high demand to short SLGB shares. The estimated float for SLGB is 3.0 million shares, which is relatively small, making it easier for borrowable shares to become scarce. While the exact number of shares currently available to borrow is unknown at this moment, a CTB like 10.04.9% strongly suggests very few, if any, shares are left. Our internal composite squeeze score for SLGB currently sits at 41.2 out of 100, reflecting the high CTB but also considering other factors like volume and price momentum. Squeeze mechanics explained. So, what does it mean when a stock is hard to borrow with such a sky-high CTB? It means the short sellers holding positions are paying a hefty premium. If SLGB's price starts to climb, these short sellers face a double whammy. Their positions are losing money, and they are bleeding cash daily from the 10.04.9% annualized borrow fee. This intense pressure can force them to cover their shorts, which means buying back the shares they borrowed. When many short sellers are forced to cover simultaneously, it creates a cascade of buying demand. This buying drives the price up even further, creating a feedback loop known as a short squeeze. Show animation. Short covering drives price. However, it's vital to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction that the stock will eventually fall, and they are willing to pay these exorbitant fees to stay short. Dilution risk check. One critical factor that can negate or severely limit a short squeeze is dilution. Dilution occurs when a company issues new shares, increasing the total share count. This can flood the market with new supply, making it easier for short sellers to find shares to borrow or cover, and often dampening price appreciation. For SLGB, our screen found no recent dilutive SEC filings like -1s, -3s, or 424BS in the last 90 days. We also found no recent reverse splits in our look-back window. This absence of recent dilution is generally a positive sign for a short squeeze thesis, as it means new supply isn't being artificially added to the market. Again, let's take a quick moment for a crucial reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For SLGB, with its 10.04.9% cost to borrow and small float of 3.0 million shares, what should you be watching? Keep an eye on the borrow rates. Any further increases will continued high levels signal ongoing pressure. Watch the shares available to borrow. If they remain at zero or very low levels, it indicates continued tightness. Monitor volume for any sudden spikes that might coincide with price increases. Remember, our composite squeeze score of 41.2 is moderate, indicating potential but not an immediate, overwhelming signal. The low relative volume today is also something to consider. While SLGB shows characteristics of a hard-to-borrow stock, it's crucial to remember that this is a high-risk area. SLGB Smart Logistics Global Limited serves as an excellent case study for understanding the mechanics of hard-to-borrow stocks and potential short squeeze dynamics. Its extreme 10.04.9% annualized cost to borrow is a powerful signal of scarcity and short interest, but it's only one piece of the puzzle. We've looked at its business, its price action, its low float, and the absence of recent dilution. Always remember to consider the full picture and manage your risk. If you found this deep dive into SLGB valuable, hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other stocks you'd like us to investigate. Thanks for watching, and we'll see you next time.